You're all doing well. Today, I wanted to talk to you about timing of this recession that we're in, timing to see if this is the right time to purchase short-term rentals. Right now, everybody's freaking out. Money's becoming more and more scarce as it's tightening up in the economy, and people are starting to pull back on their spending. It might not be sound like it's the best time to purchase short-term rentals because interest rates are going up, values are going down, people are pulling back. Like I just said, it's kind of scary, right? Well, to be honest with you, I'm going to combat that belief and that mindset to abundance mindset. I feel like now you need to have the time to be patient but aggressive. So what I'm doing, I'm going to tell you from my perspective of what I'm doing, so that it can help you guys. First of all, I'm going to be patiently aggressive. I'm not going to be, quick to jump, and I'm not going to be slow to jump. I'm going to be right in the middle. I'm going to be patient, and I'm going to go after properties, and I'm going to build my portfolio because to me, it's like dollar cost averaging. Right now, you want to kind of like the stock chart. Have you ever heard of dollar cost averaging? You're spending a little bit of money here. One month, you're doing it again next month, and you keep on doing it. And or you could do it daily, a little bit here every single day until you put the kind of money into the stocks or the market that you want into the fund. And then you have a little bit of the highs and a little bit of the lows, and together you get a better basis than you would if you were going to just throw one lump sum in. So right now we're in 2022, coming towards the end of 2022, and we're in a hell of a time, right? The recession is here. We know that we're in a recession. By my studies, I see that we're 6 months into the recession. A typical recession is about 11 to 12 months. Historically, the shortest recession was COVID. I think it was like 33 days. Don't hold me to it for those of you that are calling me out. The longest recession was like the dot-com bubble in like 2000 or so, something like that, maybe 99. And I think it was like 2 years. I think the Great Recession in 2008 was a little bit over a year and a half as well. But with that said, we know that we're not in a bad recession comparably to like the Depression or the Great Recession or even the dot-com bust. We are in a hedge to inflation. I think we're in 6 months now. Give it another 6 more months, we'll be in the spring. Whether it goes a little bit further in the next year or not, I personally think that next spring is going to be a time of slow appreciation. We're not going to have the crazy, crazy boom that we had in the last 2 years when money was really, really cheap, and it allowed that, because of that quantitative easing, because of COVID, everybody started getting short-term rentals because they were sexy. People want the lifestyle assets and stuff like that. And then the prices surged like that out of the middle of nowhere. And then it was harder and harder to compete with people because everybody was buying the same thing. Now you're going to be into a market next year, forward thinking and forward seeing this. You're going to be in a market that's typical of a normal market. For those of you that haven't been in real estate for a while, I've been in it for 20 years, and you're going to see a real market. So if you're just getting into the space in the last 2 or 3, 4 years, you haven't seen a real market. You haven't seen a long cycle at all. You're going into a normal market. We're going to have a slow appreciation market, and we're going to see that 2 to 3%. So what's going to happen? A 2 to 3% appreciation each year. So what you're going to see going into next year is stabilization and a housing correction. We're not going to have a bust or a crisis like in 2008 where we lost 50% of values. Maybe in some markets like in Houston, Texas, or some places in California, you might see upwards of 30% in some of those metropolitan markets. You'll see some of that money pull back on those values. Regular markets, you'll see upwards to 10 to 12% in a housing correction. Some markets where people just don't sell because they always want to stay there forever, you'll see, and now I'm talking about just standard residential markets, but you'll see 5 to 7% decline in values. Short-term rental markets, you could see upwards to 20, 25% pull back in values. So here's what I'm saying. I'm saying all this to say next year we'll have a leveling, a correction, and it'll be time for markets to, after they pull back, it'll be time to slowly increase like a normal market was. Longer days on markets, you won't see a 2 week home. You won't see a home get under contract in 2 weeks. You won't see it take possibly even 2 months. It might take upwards to 3, 4, 6 months. Who knows? That's a normal market. I've seen these cycles over and over and over again. Some of them are smaller, some of them are longer, some of them are big ups and downs, some of them are small ups and downs. But it's happened over and over and over after 20 in 20 years. And what I will tell you is this: I'm buying. I'm not scared. I actually just did a refinance today. I want to give out a shout out to Jay Alexander. I did a refinance today and I got a 6.75, by the way. I locked that in 2 months ago. He somehow talked them into giving that to me now, 2 months later. So he's awesome. You work with Jay. I'm plugging him in. I don't make any money off his deals, but that's just for you guys. Like, he's awesome. He'll fight for you. I think right now he told me regular rates for a Fannie Mae loan will be about 7.5%. With that said, I just refinanced the property and I'm being patiently aggressive. I just identified another property. Again, it's in the North Georgia market because it's in my backyard and it's on the other side of the mountains. I'm not going to have the Blue Ridge and LJ because I got enough up there, but I'm buying another one in Dahlonega, Georgia, and I'm going to add it to the portfolio. The numbers look great, and it still works at a 7.5% interest rate. Here's what I see is going to happen. Next month, we are having an increase in interest rates, probably 0.75. The following month, I'm guessing we'll probably have a 0.5% increase in interest rates. All of those built-in raises from over the summer to now have just finally started increasing rates on the Fannie Mae side. Obviously, debt service coverage ratio loans have gone up. And you'll see that, we will slowly have increase in interest rates. But when's the best time to buy and sell? It's always the best time to buy and sell if you buy the home right, the asset, the business. A short-term rental is a business. You're not buying a normal home to live in. First of all, you're buying a lifestyle asset. Second of all, you're buying property for cash flow. If you're not doing this for the cash flow, you shouldn't be doing this at all. You don't want to buy it just for a lifestyle asset and hope that you're going to break even. You want to see that you're going to make a 20% plus return on investment, in my opinion. I'm personally looking for 30% plus, even in today's high inflationary terms with these higher interest rates. I still want to see anywhere on the low side, 20% to the high side of 30% plus. And you can accomplish this still in today's time. You just got to be patient yet aggressive. Patiently aggressive, combining those two words. You got to look at deal after deal after deal after deal, and you've got to keep on plugging stuff in to a spreadsheet to make sure that these work. And then when you see something work, just remember that now you're in a buyer's market. You're not in a seller's market anymore, and you work the seller over as much as you can. Not in a bad way, but you negotiate. Whereas 6 months ago, you couldn't negotiate. You had to pay your own closing costs. You had to pay top dollar or a little bit above list price. Now you can negotiate. You can offer $50,000 less, $10,000 less. See how motivated the seller is. And then on top of that, get them to pay your 3% closing cost. Get them to fix the freaking repairs that were on the inspection report that they wouldn't have done last year or 6 months ago. You work the seller and you get the best deal possible for you so that you will have a great cash flowing asset to put onto your portfolio. So right now, my team and I, we're going to be buying properties. We're going to be slower. We're going to be making sure that these things are profitable. And we're not just buying anything and everything. And then we're also vetting our comps a little better than we were before on AirDNA, because I do have some properties that are making less than I thought they would because they were having those inflated numbers from 2020 and 2021. So what I'm doing, which I think you guys should do, is if you run AirDNA numbers, you need to look at the 90th percentile, make sure that you are in line with that. And then on top of that, take 10, 15% off. I'm taking 10% off the top. So if it says I'm going to gross $100,000 a year, I am going to put on my spreadsheet and I'm going to say that I'm going to gross $90,000 a year. I don't want to be a victim of my own circumstance and take AirDNA for what they're telling me, because I've obviously been bit in the butt over the last 2 years of their earnings that they're reporting, because they review 12 months in the past in arrears, and you have those comps. And obviously the people that were buying in 2021 saw 2020 comps. People that were buying in early 2022, we saw 2021 comps. Now you're at the end of 2022. You've pretty much seen the end of 2021 through now on AirDNA. That's a little bit of a slump year as far as economy is pertaining. And on top of that, you actually see a more realistic comp that was more or less mirrored to 2019. So if that's the case, here's what I'm doing. I'm just taking that number, even at a 2019 mirror for 2022. I'm still going to take 10% off just in case we go into a longer recession in the next year. So over these next several months, I'm going to be buying. I want to grow from 20 plus homes to 30, 40, 50. I want to keep on building this portfolio, this Southern Charming vacation brand that I want, of a portfolio of boutique homes. And we're going to keep buying properties, but we're going to be patiently aggressive, and they're going to cash flow even good. And it's like I told you guys in the past, if a property had a 3% interest rate, and now I'm going to pay a 13%. Let's just say we mirror the 1980s at the end of next year. I don't think we're going to go into that necessarily. But if we get to like a 13% interest rate for investors, then I'm still going to buy. It doesn't scare me. It doesn't halt me. I'm buying cash flow assets. So I'm going to end it with this basically. I'm going to wrap up in summary. Now is a good time to buy. It's always a good time to buy. People bought in the 1980s. People were buying in the teens back then. I know people in GoBundance who bought properties at 12, 13, 14% and sat on them. And then they sold them 20 years later, and they are so happy and glad. Of course, they refinanced them in the process when the interest rates came down, but they're so happy and glad that they had that long pay down. The five wealth generators, they had the long pay down. They had the 2 to 3% natural appreciation. Sometimes they force the appreciation through renovations over the years. They have the depreciation from cost segregation studies and or natural or just regular standard depreciation. They also had different things that they could do with these properties to build wealth with, like I said, cash flow, loan pay down, and so on. So there's all these different things that they did, and they're so glad that they had these properties. Here's the best part. The fifth wealth generator is the refinance. This is why it's so pertinent to keep buying right now if you can. The refinance is what is key, because if you buy a freaking property and you're at 12% interest rate next year for some reason, or maybe 9% now, the Fed will pull back rates. They will probably pull back rates early next year and stabilize the economy a little bit to propel it so that we can have that 2 to 3% natural appreciation. But in 5 years, typically on this kind of a recession of this scale, 4 to 5 years from now, they do a bigger pullback, and then rates will drop. So if you can cash flow now at 12% or 9% or whatever it is next year, just know 3, 4, 5 years from now, rates come back down 30% cheaper than where they are now. Let's say it was 10%. Now they go down to 7%. You're going to cash flow that much more. On top of that, you are becoming a stripper, is what I call it. You're a stripper. You're stripping your equity. You pay down your property over a period of a few years. You might be able to pull out $30,000 in tax-free money, because it's equity. It's not income. You don't sell it. You cash flow at these higher rates. You refinance the thing, and then you cash flow even more because it's a cheaper rate. Plus, you pulled money out and you stuck it in your pocket. So it's even a better win-win. You have cheaper interest rate later on down the road. It cash flowed up front at a higher interest rate. You know it's going to cash flow even more at a cheaper interest rate. And you made a little bit of money that you don't even have to pay taxes on. This is how the wealth gets wealthier. This is how the rich get richer. We know how to utilize 1031s if we're going to sell stuff. We know how to do cost segregation studies, even though they're going away down to 80%. There's other ways. There's other loopholes. We know how to stack wealth generating modules and vehicles on top of each other, one after another, one after another. I've learned this thing over 20 years, and it works. It works. So is now the right time to invest in short-term rentals? Of course it is. Hell yes, it is. It's definitely the right time to invest in short-term rentals. And I will finalize with this. I said that I'm wrapping it up. Now I'm finalizing with this. Entities, corporate entities. They're buying, they're entering into the space, and they're going to become your competition. I believe in certain markets, corporate structures and entities will come in and will buy people out like us. So if you have a $20 million portfolio, like I do, or you grow it even bigger over time, over a period of a few years, what does it look like when Blackstone or somebody out there wants to buy your portfolio because you have the right systems in place, you have the right staff in place, you have the right branding in place, you have the right assets in place in these desirable locations. They want to buy you out because they can get a better return on your investment buying it off of you, a mom and pop, than somebody else who's doing single family homes. Like, that's where we're going into the space, and that's why I think now is the right time to buy and to continue to buy. That's it. So look, guys, I do want to say this. We are at the point now where we are doing our December 3rd and 4th event. If you haven't signed up for this, we got like 40% of the tickets sold. If you haven't signed up for this, come into Atlanta. I live in a suburb of Metro Atlanta. You will come into my office where I'm at now. You'll break bread with us. We will teach you education on the first day. We will analyze your business. If you have existing property, we will help you with my whole team break down all the different things that can help you become that much better, make that much more money, help you integrate stuff, help you write copy with our AI generating software right there on the spot to make your property better. And then on top of that, we're going to do awesome sessions. We're going to eat dinner together. We're going to do some cool stuff. There's some cool stuff that we can teach you that you may not have integrated yet, and or we can stimulate your mindset and help you think so that you can get rid of those ceilings in your head that's trying to cap you because now the market's kind of freaking you out. And just realize that when you're around like-minded people, you become like-minded with them. And the people you hang out with the most and give you those new mindsets, they help you become that way too. So that's kind of what we're doing. We're going to break bread with you. We're going to hang out with you 2 days. Last time, this is even better. Last time I did this, it was 1 day. You guys get 2 days with us. We're going to do all the education stuff that I did last time, but we're also on day 2 going to take it easier, and we're going to work through your portfolio. And if you don't even have a property, that's fine too. We'll help you find a property utilizing STR insights and things like that. So guys, is that the right time to buy a property? It's always the right time to buy a property. It's just a matter if the cash flows. So I hope this helps. If you guys have any questions, comments, concerns, let me know. Thank you for listening to the podcast. If you're watching this live on Facebook, our lives are broadcasted into the podcast, 5-Star STR Success. We have over 100 episodes on there. I would like for you to give us a 5-star review, give us a good review. And then on top of that, we have been dumping them in here and out over the last month as we brought the podcast back. What we're doing from here forward is we are going to release on Tuesdays and Thursdays and be under a normal schedule. All these lives that we do in the Facebook here, it's going to be there in audio form if you want to go back and listen again and or listen to 100 plus other episodes. Guys, thank you so much. Talk to you later and see you in December for those of you that are signing up and or have already signed up. See you. Thank you.